Good afternoon, everyone. Mike Banner here, March 1st, the first episode of 62 Who Knew, first Monday of March of 2021. We welcome you for being here. We want to thank everybody that watched last week. We had a wonderful show. We had a record-breaking amount of television audience, just a little over 80,000 viewers, and we thank you so much for that. Very excited about today's show because it's my favorite topic, my two favorite topics. But before we get to that, and I want to get to that quickly, I want to do just the same thing that I always do at the beginning of every show, just a quick synopsis of what 62 Who Knew is all about for our new viewers. Trying to get to that 100,000 mark. I think this might be the show. Where we do it, quite frankly. What is 62 Who Knew? What is the premise? The premise of this show is, who knew at 62 that we still had almost half the time that we've been here on this planet, another 30 years ahead of us? My father, his father, and probably his father before him, as they approached the age of 62, they had questions. Pretty much the same questions that I had. I turned 62 approximately 7 months ago. And we all have the same questions, except for the top 1% of the wealthy of the world. The other 99% of us, we all have the same questions. Should I retire? Do I need to keep working? Should I take my Social Security now, or should I defer it for a later date? Do I need long-term care insurance? Am I too old to get it? Do I need life insurance? Should I keep my present life insurance? Can I increase it at this age? It's not time to think about Medicare supplements, right? That's at 65. Invest in the stock market? Little chancy, I'm getting older. Annuities? What? Bonds? We all have the same questions, except for my generation. The generation of which 10,000 people a day are turning 62 years old in the United States of America. Not the world, just this country. 10,000 people a day, okay? We have one more hurdle, one more bump in the road that our fathers and their fathers didn't have. That's what I brought up at the very beginning. Longer lifespans. According to the American Medical Association, if you live to be 62 in this country today, you have better than a 50-50 chance of making it to 90, all right? And if most of you, or some of you that have been diligent watchers since the beginning, you've seen some of our other guests, including the Weizmann Institute from Israel, who have said with medical breakthroughs, scientific technologies of the next decade, not the next 30 or 40 years, the next decade, that statistic of living to be 90 could very well be in the hundreds. How do you plan for living the next 30 or 40 years? And that's the premise of 62 Who Knew. Every week we endeavor to bring on experts in all the topics I mentioned earlier: Social Security, deferment of Social Security, long-term care insurance, life insurance, Medicare, Medicare supplemental policies, reverse mortgages, health, psychological and mental guidelines of what happens when you stop going to work, when you have something to do every day and suddenly you're sitting home. Not everybody enjoys fishing or golfing or playing tennis, or if you're in Florida, pickleball, 7 days a week. You think you're going to, but it wears off. And that's what this show does, and the premise has been very well accepted. We want to thank you. This is our 95th show, and for us to be drawing 80,000 viewers per week and growing, we thank you very, very much. So let's bring on our two guests, and there they are. As most of you know that have viewed the show or that have seen us on LinkedIn or Facebook or on any one of the platforms of our new podcast, which is simulcast at the same time that we're doing the show, 62 Who Knew made a commitment in the second week of January of this year to spearhead an initiative, a national initiative, to bring long-term care insurance to the masses. Long-term care insurance is a staggering product that everyone needs, but has always been aimed towards or most interested in by the wealthy, the upper middle class. But what about the masses? They deserve that protection too. And what they don't know is there are incredible long-term care insurance options for them, but it's not targeted to them. 62 Who Knew wants to target it to them. And in that effort, we brought back two of our experts from that panel in the second week in January, on our right or your left. I don't know which way you're facing at your TV, but the man on the other side of me, Mr. Bill Comfort, known nationally as a long-term care insurance expert, public speaker, also top instructor of the CLTC designation. That is the certified long-term care designation. It is the top designation in the country for long-term care insurance people. Mr. Comfort, Bill, has taught literally thousands of people and certified them. If you're a financial planner, you want to be a certified financial planner. If you're an accountant, you want to be a CFP, a certified public accountant. And if you sell long-term care insurance, you want that CLTC designation. And a man that has been on our show several times, again, well known throughout the country for his expertise on many media public outlets, just throughout the country as a reverse mortgage expert. Now, let's talk about that for a second, because Stephen has filled a niche, quite frankly, that needed to be filled in the reverse mortgage world. People think of reverse mortgage, and we're going to talk about this today, and they have that knee-jerk reaction. The poor person, the lower income person that needs help. And make no mistake about it, Stephen helps those people. But Stephen has focused, he has zeroed in and drilled down on how to use a reverse mortgage, how to use your home equity, your housing wealth, as an overall part of a more comprehensive retirement plan. He speaks on it throughout the country. His videos are very well known, and it's just incredible to have these two experts who are at the top of their field, part of the 62 Who Knew initiative to bring long-term care insurance to the masses. Thank you guys for being here, as always.
Great to be here,
Pleasure
Michael.
to be back.
All right. So we made some promises in January, and it's only 7 weeks later, but I want to discuss just briefly, and then we're going to go into real products, what we do, how we're doing it. We've made a lot of headway in the last 7 weeks. I know, Bill, you've gotten permission from the CLTC school for the three of us in different ways, and together and separately, to do a webinar series to talk to thousands, I hope, tens of thousands, but at least thousands of CLTC designated people on how to bring long-term care insurance to the masses. And I know you're gonna say no. That's, well, I don't know what you're gonna say, but when your name goes on a mass email to long-term care insurance people that you're involved with a project, we know we're going to have an incredible amount of participants. And I know Steve feels the same way. I can't wait to do this with you, and we should be doing it in the second quarter of this year. Is that correct?
We're moving that way. Yeah.
All right. And Stephen, I know you've discussed certain things, and you're doing certain things with Bill as well. Would you want to let us know a little bit about that?
Absolutely. And just to let you guys know, I am not hearing Bill, so I don't know if we have some technical difficulties or not, but great to be back with you on the 62 Who Knew show, Michael. Yes, Bill and I are really excited to partner up later on this year. I received my CLTC designation through Bill's training and tutelage late in 2019. And we've been working on ways to partner ever since. And this year, Bill and I will be working together to rewrite some of the curriculum for CLTC to make sure that the proper information about reverse mortgages has been built into the curriculum, and also for us to appear on the webinars and trainings for anybody that's looking to get the CLTC designation to have a deeper understanding and skill set when it comes to all things reverse mortgages.
That's to actually have someone of your stature assisting Bill in updating the actual guidelines of what's taught in the CLTC classes is staggering to me. And to my knowledge, I should have mentioned this when I introduced you, I think you are the only reverse mortgage professional in the country that took Bill's class. So you could learn all there was to learn about long-term care insurance. And I think that's, you don't even have an insurance license, do you?
I don't, no.
Yeah, you just
I
want to
wanted
learn.
the CLTC really just for my own benefit and for my group's benefit, so that I know more about long-term care insurance, and I can really hone in on what the costs are, how these products are structured, so that we can work with our clients to help them fund the long-term care insurance products or self-fund care, whatever is going to be most suitable for the client.
Bill, I don't want to take too much time going backwards, but you told a very interesting story, both of you did, about when you brought up reverse mortgages in the class, and Stephen happened to be there, that many of the students in your class did in fact have some sort of surprise or reaction. Reverse mortgages, you sure? But with Stephen there and you to set them a little straight, that you actually had some very positive reaction to having Steve in one of your classes.
Yeah, it was, Stephen was in the class that I taught a year and a half ago or so. We have had a few other reverse mortgage professionals take the course in other formats and with other instructors. And I know Stephen kind of has a vision for his industry to take this training, because it's not just long-term care insurance. The way things ought to be integrated. Long-term care planning, yeah, there's insurance, but what about the VA and Medicaid and Medicare and reverse mortgages? And so I knew that Stephen was going to be in the class, and we had met and talked before we got to it, but then reverse mortgages come up in the curriculum, and I'd asked Stephen, he was gracious enough to agree to take a few minutes to kind of teach all of us from his perspective. And it turned into probably a half an hour discussion from a lot of different angles. And, there were a couple of folks who'd heard about it but just admitted they didn't know much. A couple of financial advisors who were very cold, I think, if that's being fair, Stephen, to the subject coming into the class.
Probably polite.
And everybody left with this new appreciation for this financial tool. And I think, Stephen, you've even continued a number of relationships professionally from that course as well, which shows the power of the connection.
Absolutely.
Yeah.
That course was invaluable for me to just absorb the knowledge, but then also to have an open platform to engage with advisors and insurance agents who, view reverse mortgage as it used to be 15, 20 years ago, and that's a loan of last resort.
Right.
And what we teach advisors and what we teach our clients is, that's the old way of doing reverse mortgages. Mm-hmm. The new era of reverse mortgages, really since 2013, 2014, where the American College has gotten behind it with their retirement researchers, Wade Fowle, Jamie Hopkins. They've studied reverse mortgages in depth, and what they have discovered is that reverse mortgages are most beneficial when used proactively and not reactively in someone's retirement plan, using housing wealth first, not last. And advisors have really caught on to that. I think it's why our business is up so much. I mean, look, our volume over the past 24 months is up over 500%.
Yes.
And that has a lot to do with long-term care insurance agents, with financial advisors, with those who never really looked at reverse mortgages in the light that they have discovered them to be currently today. And we're just getting started. And Bill and Michael, I am so thrilled to continue this mission with the two of you to really bring together two industries who, in my eyes, should have been together a long time ago, but to now spearhead this initiative for the betterment of advisors and insurance agents, but most importantly for the betterment of the clients across the country that we help, that are going to be able to better position their comprehensive retirement plan because they're going to have the knowledge and the information about these products and then determine and be empowered to use them where they see fit.
Exactly. And we were discussing this. Oh, I'm sorry. Go ahead, Bill.
Oh, I was just going to say, Michael, Stephen used a word or a phrase that I think we probably need to keep coming back to in this discussion, and that is the shift in the view of a reverse mortgage as a financial resource, a financial product, a financial tool in the broad scope of financial and retirement planning, and that it's best used proactively, not that loan of last resort or money of last resort. And of course, with any insurance, especially long-term care insurance, you must be proactive because you have to be healthy enough to medically qualify for the coverage. You cannot wait, as I like to say, you can't wait till you hit the tree to add collision to your auto insurance.
Yeah.
You can't wait until you're diagnosed with a, disabling, debilitating condition to buy long-term care insurance. So this idea of being proactive planners, that fits together perfectly. Whether it's ideal for everyone or not doesn't matter. But this idea of proactive planning to put you and your family in a better place in the future, there's the power of the connection.
Absolutely. And, you mentioned a couple of absolute great names, Wade Powell, Jamie Hopkins. These are brilliant, brilliant people. And for the last 2014, for the last almost 7 years, they're putting out their white papers, they're putting out their articles, and we need that. We need them to continue doing that. I think, I'm going to try and put this the right way, because I don't remember the way I put it several hours ago when we were talking, and you said, Michael, you should say that on the show. We need those learned people. It gives us credibility. But now it's time for people that actually do it for a living. Don't talk about it. I don't mean that disrespectfully at all to those brilliant people. But we do this for a living. Bill just doesn't teach about long-term care insurance. He sells it, has for decades, and helped tremendous amount of families. I've heard, some of your stories when you speak in other places about how you've helped families. You, Mark Goldberg, Peter Gelbwax, Stephen, we've known each other now going on 2.5 years. The stories that you have shared about using a reverse mortgage. I hope we can be not the three that talk about it, but the three that actually do it. That we're out there pounding the pavement and actually doing it. That would be an incredible thing.
I think we're on our way.
We are.
I think we're just getting started on this initiative. I think there's been a lot of good work, quality work done by Bill for years, training these professionals who are now on the front lines to provide their clients with this education that they wouldn't have had it not be for the three of us and others having these conversations to really align forces. And again, it's for the better good of the client. There's not a lot of places that clients can go to look for information. And I think that's a credit to you and this show and this platform, Michael. 62 Who Knew is that platform. Otherwise, where do they go, right? They go to Google, and then who knows where they wind up from there. Yeah. Your viewership and the fact that you have over 80,000 viewers watching this show because it is the financial resource. It is where they go to learn. And as your audience grows, so too will our ability to get this message out to the rest of America. As at the same time, we're working on a business-to-business standpoint, continuing to educate advisors, continuing to educate insurance agents, rewriting curriculum for the CLTC textbook, partnering in these unique ways that are going to allow us to help the masses.
Absolutely. And we all decided today, because we always speak, that we want to get down to a little more brass tacks and drill down, do some things that we did on that first show of the year, which was amazing. But before we do that, you told me about experience that you had in the past, Stephen, where you were giving a webinar to some certified financial planners, and I'd like you to repeat that story because I know we have consumers listening, but I know in the 80,000 viewership we have long-term care insurance people listening, certified financial planners, IFAs, independent financial advisors, and I want you to listen to this story because we have to overcome this as well. But please go ahead.
Yeah, I appreciate that, Michael. So I was giving a webinar, as I often do, to a large group of financial advisors and insurance agents, and all about reverse mortgages, just A to Z. But particularly, this was a high-level conversation to advisors who really understand these strategies. They understand leverage. They get the concept of using housing wealth in retirement. In large part, it's just getting them over the stigma of reverse mortgages. Through this webinar, probably about halfway through, I brought up long-term care and the fact that you absolutely can use a reverse mortgage, proceeds from home equity with a reverse mortgage to fund specifically a long-term care insurance policy. And you kind of heard, and this was a webinar, right? So you don't get the benefit of seeing the eyeballs in the room, and you don't get the benefit of reading reactions, but you could just hear a gasp, like I can't believe he said that. And the CEO of this large financial organization came on and said, well, Steve, let's take a step back for a moment. I don't know if we can quite go there yet. Yes, you can use a reverse mortgage to pay off and replace a traditional mortgage loan, thereby paying off that mortgage, freeing up that cash flow because there's no mandatory mortgage payment with a reverse mortgage. So the additional cash flow, yes, that can be used to fund a long-term care insurance policy. And I said, respectfully, I believe, and it's not just my opinion, but other opinions in the reverse mortgage industry and in the financial planning community have come together, and we all collectively agree that yes, you can compliantly, without question, use proceeds from a reverse mortgage to fund a long-term care insurance policy. Now, of course, there's parameters in place that you can't cross-sell, right? So the insurance agent can't be the person originating the reverse mortgage getting a commission for the insurance. And Bill can speak more with more authority on the regulatory and the compliance aspect of this. But bottom line is you can 100% use a reverse mortgage to fund a long-term care insurance policy. Yet, this CEO of this very large financial planning firm with hundreds and hundreds of advisors across the country didn't understand that. And it wasn't until after the webinar where we spoke offline and I got him then to agree that, oh, you know what, you're right. If you set up these parameters and if you do it this way, that way, and that way, yes, then sure, you can use a reverse mortgage to fund a long-term care insurance policy. But they weren't using these strategies, costing their clients an untold amount of money because of all the other advanced planning strategies that a reverse mortgage unlocks. And it was kind of shocking. It was, but it wasn't. I was a little taken back by it. It is what we have to deal with every day. These are the misconceptions that we need to overcome. And as we move the ball in educating the financial planning community, hopefully these misconceptions go away. But they still exist, and it's costing clients a lot of money.
And it's costing, I think, literally millions of seniors that don't think they can have long-term care insurance are not even bringing up the topic of long-term care insurance because they think it's out of their reach. And that's what hurts me the most. Bill, take it from there, please.
Well, that's a great point, because often one of the biggest objections, not just to not buying the insurance, but to having prospective clients not even engage in the subject or a discussion around long-term care insurance, is they think, they've heard, they've read, it's just too expensive, or it's so expensive, or we can't afford it. Or maybe they've even looked at it, they've priced it, they've looked at premiums, and they start thinking about how could we even do that from our cash flow, or it would take too much from our cash flow, or too much out of our assets. And right or wrong doesn't matter, because that's their decision and view. And then you all of a sudden see that the home equity is another asset. Now, I'm not saying that this is the answer to everything, but it's a piece of financial resources that can be leveraged. Even part of the reverse mortgage proceeds,
Right.
whether it's a lump sum or a payment over a term, or the example that Stephen mentioned, a lot of financial advisors already are thinking about pay off the first mortgage and put that cash flow back in your pocket. However you pay the insurance premium, the reverse mortgage can make money available to help do that. And what if you can create many more multiples of dollars for care than the premium that goes in to the insurance policy? I mean, just a very simple lump sum example, a $100,000 premium could produce $400,000 or $500,000 of long-term care coverage. And what does that protect? That protects a whole lot more than just the home equity, and not only the finances, but protects the people, protects the spouse and the kids from the burdens of having to be 24/7 caregivers, at least. So this idea of availability, that there's money that could help pay needed, necessary, valuable premiums for long-term care insurance, is the idea and concept and view that we have to start looking at much more broadly, particularly in financial services and especially in long-term care planning as well. We can, and Michael, I'm completely with you, we can help so many more folks. I don't know exactly what the number is, but if 20, 30% of people who looked at long-term care insurance and didn't buy it because they decided it wasn't affordable, what if we could show them a way that made it affordable?
Yeah,
for them?
the direct question, which is what I would like to train, I don't know, a few million insurance people to say, is I understand that. But if we eliminated your mortgage payment, could we continue this conversation? That in itself, and I don't know the number either, but I do know numbers of how many people that are 62 years old and above in this country, and how many, not billions, trillions of dollars of equity they have. If, in fact, we just concentrated on the people, that we could eliminate their first mortgage payment and then say to them, what your average mortgage payment in this country is $1,200 a month. And they're not going to spend anywhere near $1,200 a month on a good long-term care insurance policy.
Right.
They could have that protection and still have extra cash left over. I know, Stephen, you got so many examples. They'll have even more extra cash, disposable income. And to have that coverage, again, specifically, I don't like using COVID-19 as a scare tactic. I think it's tacky. I think it's wrong. But COVID-19, to me, just multiplied, my, quite frankly, experience with my dad 15 years ago. Dad did not have long-term care insurance, but he had great insurance. Well, he was in his 80s, so he had Medicare. He had a fantastic Medicare supplemental policy, okay, through MetLife. We'll give them a shout-out for Snoopy, okay? And he was a fairly highly decorated World War II POW. So he had some stuff coming from the VA. Even with that, and he lived with me and my two children, to take care of Dad the last 12 months of his life, we spent what most would consider a lot of money for the help that we needed. Because I didn't want my father in a home, no matter how great it was. I wanted him having Chinese food with me and my kids and watching, I think at that time it was NYPD Blue. Remember that program? And all the things that we watched together. To think that we could bring that, I know the number is in the millions. I just, it's a mathematical fact. Or at least give them that option. It takes my breath away. We got to do it.
Yeah, if we accept the premise that reverse mortgages are are often used, are well used, and have been viewed as being a key resource to help people stay at home and age in place even with the need for care. You know, the phrase is, use your home to help you stay at home. But that was always in the context of the last dollar. Use your home equity to pay directly for the cost of care. Well, what if we could use your home equity and multiply it by 3 or 4 or 5 times? That will help you stay in your home even longer. Or if you can't stay in your home, the long-term care insurance will pay for assisted living. Home equity won't pay for assisted living.
That's right.
If you've used it up and if you're no longer living in your home, if you were single, for example.
Exactly.
Right? Now you're, and long-term care insurance can cover that as well. I think one of the things that's exciting, and Stephen, maybe you've got some ideas on how this could work together. But one of the failings that I see, failing's too strong a word, but we tend to silo planning concepts. So people want to age in place, but they often have to do significant remodeling of their home, or they need to buy a home that's more, you know, universal design, aging in place, friendly. But to really age in place, you need to have long-term care insurance to pay for the cost of care. I could see a reverse mortgage helping people do both, fund significant care and improve the home to make it possible to stay.
Well, we see that every single day. We see that coming to life through our clients and what we're able to help them out with. I think I want to backtrack for a moment because as both of you were speaking, you know, a story from this afternoon came to mind. So I had a call with a client and her advisor this afternoon. She has a mortgage that she is looking at paying off through the reverse mortgage. There's not a lot of cash available to her after paying off the mortgage. She has a mortgage payment right now. It's currently escrowed. And the actual principal and interest payment isn't that much per month. It's about $650 a month. Her payment's about $1,000 a month with escrow. But she still has to pay the taxes and the insurance, even if she has a reverse mortgage. That's the responsibility of the borrower, the reverse mortgage borrower. You have to pay your insurance, you have to pay your property taxes, and you have to maintain the home. And so she said to me, Steve, this all makes sense and this is great, but it's only $650 a month. That's not that much savings. I really don't know if this is worth my while. And I said to her, well, how long of a term do you have left on your current mortgage? 24 years on a 30-year mortgage. Okay. She's about 65 years old. So I said to her, well, I understand $650 doesn't seem like a lot of money every month, but let's look at how much that is per year. And then let's extrapolate and look at how much that is over 20 years. That's about $150,000 over the course of 20 years. Are you planning to stay in your home for the next 20 years? Yes. I want this home to be my forever home. I don't want to go anywhere. I love my home. Okay. So you're telling me you want to stay there for at least 20 more years. You're going to save $650 a month, $150,000. Okay. And her financial advisor is on the phone. Mr. Advisor, what could you do with $150,000 of freed up cash, right? What does that equate to? How much could you turn that $150,000 into over the course of 20 years? And he said, Steve, based on our historical data and what this person's portfolio has done over the past 10 years that we've been working with her, that $150,000 is likely going to be doubled. Mm-hmm. There it is. So now there's a pool of $300,000. She's young enough. I think long-term care insurance would still be affordable. Bill, correct me if I'm wrong, but I think until about 70, maybe 75, for a healthy person, a long-term care insurance policy is relatively affordable. And I know that's a relative term, but her mindset just needed to shift. It's not the $650 a month. Mm-hmm. That doesn't sound like a lot of money. I mean, it is a lot of money, and to a lot of folks, that could be the difference between eating or not.
Yeah.
But to her, $650 wasn't that much. $150,000, $300,000, well, that's a lot of money. And the advisor was very excited about this. Who wouldn't want to grow somebody's retirement portfolio by $300,000 just by eliminating the mortgage payment? And so the concept just needs to be told in a different story, in a different light. These are successful reverse mortgage strategies. This is how today's reverse mortgages are being used. It's not the loan of last resort.
Right.
And for her, she's looking at reverse mortgages in a whole new light. Maybe it's going to be purchasing a long-term care insurance policy. She wants to be in the home for the rest of her life. She's going to need to pay for care. How is that care going to be paid for? These are the conversations that we need to be having.
Absolutely.
And how can that be? How can that 650 be allocated? If it all goes into investments, the advisor has an idea there. What if part of it goes into insurance and part of it goes into investments? As I think about my industry, insurance, sales, financial planning, financial advising, I think that the primary objection to using reverse mortgage to fund long-term care insurance, like the story of the group you were speaking to, Stephen, I think it's an ethical pause. Is this ethical? Is it ethical? Is it right? Is it fair for a financial advisor or an agent to suggest or recommend that a client use their home equity to buy an insurance product, which they may or may not use? And so that leads us to some questions, and I think begins to outline some guidelines.
Yes.
And what's interesting is they're not guidelines that are unique to reverse mortgages paying for long-term care insurance. They're the same ethical guidelines we got to follow on every recommendation we make every day. Mm-hmm. So the thing that keeps coming up in my mind, and even if I hear 67, 68-year-old, they've got $650 a month in free cash flow, I know I can design long-term care insurance that's going to be significantly helpful and not even use all of that necessarily for them. Or if they happen to like the idea of the lump sum, because there are some single premium long-term care policies that also include life insurance. Now, for $100,000, because of the life insurance, you get a little less long-term care than if it just went straight into pure long-term care insurance. But what if you never needed long-term care and that $100,000 comes back to the estate as a death benefit? Now, that makes a lot of sense, because then that $100,000 pulled from the home equity, in some ways, it's either going to pay for care or it's going to come back to the estate or whatever. So these are ideas. The question is, or what my worry even, and I'm all in on this concept, I don't think, and this is, I'm going to overstate this, but it's a starting place. I don't think it ever would be appropriate to use 100% of that lump sum from the reverse mortgage, or 100% of the free cash flow for long-term care insurance. Now, there could be an exception, right? There's always an exception to a rule. And I think that's what we need to be careful of. And it's really easy for critics to dismiss things with these zero-sum solutions. Mm-hmm. You use a reverse mortgage for that, it's not appropriate. Well, what if we use part of it? And the rest of it creates a home that they can live in safely, even if there's walkers or a wheelchair or whatever, or to put into funding to create additional liquidity for emergencies, whatever it is. So I think that's one of the first things we need to begin to talk about, is where are the guardrails ethically, best interest. And what keeps coming up in my mind is, no matter how you structure it, replace turn the mortgage payment into more cash flow, take a defined monthly benefit from the reverse mortgage or the lump sum in whatever form. I think our first guideline is you probably should never use 100% of it to buy long-term care insurance. But my gosh, even a portion, Michael, this is back to what you're saying, even a portion, I think would free people up, would give them permission to own insurance that they'd like to have, but they just haven't seen their way forward to afford it.
Exactly. And well, Stephen, I want to hear your take on that, because you said something that really does resound with me. But go ahead, Stephen.
I agree with Bill, right? I mean, we want to do the right thing by the homeowner. And if that right thing is using a reverse mortgage in a unique way to help pay for a long-term care insurance policy, great. We look at suitability before anything else. I'd say we probably turn away 15 to 20% of clients that come to us asking for a reverse mortgage because it's just not the right thing. We have an ethical and a moral duty to serve our clients. Our reputation is on the line. Our license is on the line with every single conversation and every single transaction that we encounter. But as Bill was speaking, you know, I'm listening, and I'm realizing that I think the biggest problem in both the reverse mortgage industry and the long-term care industry, and just in financial services and a lot of industries, where do people turn to for education? Oftentimes it's Google, and you just don't know what you're going to find on Google. You have these so-called experts offering their opinion. They don't write long-term care insurance policies. They don't write reverse mortgage loans. They're opinions. They're just opinions. And it's very easy to have these social media muscles and to have these strong opinions if you're not in it, if you're not living and breathing it every day. If folks would reach out to Bill and understand long-term care, or reach out to Michael, or reach out to me and my team, just not to get a long-term care insurance policy yet, not to get a reverse mortgage yet, but just to become educated. I think one of the biggest problems just in America is people are afraid to be sold something. They're not going to call Bill because they're afraid he's going to sell them a policy, or that he's going to try to sell them a policy. And the same holds true with a reverse mortgage or a traditional mortgage, or it's the reason that most people don't have a financial advisor. They're afraid to, one, address their situation, and two, they're afraid to be sold something. And I think people need to almost get out of their own way. Go get educated. Go speak to somebody. Go speak to an expert. If you're looking at a long-term care policy, speak to somebody who specializes in long-term care. If you're interested in a reverse mortgage, don't speak to any mortgage loan officer that's going to write one or two reverse mortgages a year. Speak to an expert. Speak to somebody that originates hundreds of reverse mortgages a year, that does this exclusively for a living. But there's a void of information out there. And it's not that there's not good quality people putting the information out there. It's people are afraid to actually go get it. And that's something that I think this show is helping to overcome.
The only thing that I'm going to disagree with you on is there's no void of information out there. There's a void of correct information out there. Because, oh my God, when you talk about, my daughter always fools around with this, the power of the Google. The Google knows all. Oh my God. I mean, I think the last time I checked, and it's been a while, I Googled reverse mortgages, and there were 12 million entries.
Yeah.
I mean, where do you start? And something that you said, Bill, that really does resound, we've never talked about this, is when you said maybe not to use 100%. Something that resounded in me is I've sat in with enough meetings. I am not a certified financial planner. I don't pretend to be, but I've sat in with certified financial planners in my mortgage career, not just reverse, but regular mortgages as well, and heard brilliant financial planners for decades now look at clients of all ages and say, look, we don't want to take your portfolio and put it all in one place. We don't want it all in the stock market. We don't want it all in high risk. We don't want it all in low risk. We've never talked about that, but that does resound to me. If we can get you $100,000 out of your house, should you put it all into anything? No.
Right.
My first knee-jerk reaction is no. Let's see what you need I can't do that, but professionals like you guys can, and then decide what to do with it. But also, you brought up something, Steve, the fact that we're trying to push this platform, and Bill and I have been trying to push it for, what, 70, 80 years now? I don't know. And we don't have suitability features. Why HUD? Why insurance commissioners? Why MetLife, Genworth? I could go, no, you can't do that. Why? Well,
yeah.
I don't think we can do that. Why? Maybe, and this is a separate show, I'm just saying this to you two, so the other 80,000 people don't listen to this part. Just like we came up with the firewalls and safeguards that HUD never gave us, but now we have them, maybe we need to come up with suitability features. I mean, really and truly.
There are some suitability guidelines already on long-term care insurance.
Yes.
If you're paying an annual pay-as-you-go premium, there's a guideline. It's not hard and fast. A consumer could still choose to do it if they exceed the guideline, but they have to sign a statement that says they understand this guideline, and that is you generally should not spend more than 7% of your income on long-term care insurance premiums. Now, again, there are circumstances where it could be a little bit more than that, but you start getting up to 10, 12, 15% of income on premiums,
that hurts.
There better be some pretty significant exceptions, and the agent and the buyer must sign off that they understand it may not be appropriate because it exceeds this threshold. That's already in place. The single premium, the lump sum, moving money from a CD or a money market or investment over here into one of these single pay lump sum products, there's not quite the same guideline, but there are some developing thoughts about how much, what percentage of your total portfolio or total net worth ought to be reallocated that way. So some of these things exist already in long-term care insurance, and I think that's, just as a starting point, I think that's our second big kind of guideline. Yes, there could be exceptions, but our second guideline is, and I think we discussed this on one of those first shows as well, but I wanted to highlight it a little more here as we're talking more specifically about how these two products can work together. The use of a reverse mortgage to pay the premium in whatever type or form should only be used if the client, the applicant for the insurance, would have otherwise qualified from income or assets anyway. The reverse mortgage just helps them do it with more comfort, with more ease, with more flexibility in their total portfolio. And I think that's just another outstanding kind of a guardrail to begin to think about as we go along here. But again, there's plenty of people where they're just not comfortable making that commitment of dollars, even if they have it.
Right.
But does it free it up? How about this? And Stephen, maybe this is, you've probably got a story that goes with this as well. But I imagine, as Michael was talking a moment ago, that somebody might be able to afford the premium, might choose to pay it out of cash flow or with assets that they have, but establishing a reverse mortgage, maybe a line of credit, just sort of backstops that decision in case things change in the future. I mean, that would be appropriate as well. The reverse mortgage isn't directly funding it, but it's helping them fund it.
Yeah, using what is in most cases their largest asset to replenish funds that have been allocated to pay for the long-term care insurance policy. What you're saying, Bill, makes so much sense. It almost doesn't make sense. Right?
Yeah.
These are common sense concepts that are just brilliant. I mean, I love that you should be able to qualify with your own income and assets, and the reverse mortgage is just that financial tool to help alleviate some of the pain. That makes a lot of sense. I think people still have that misconception about the reverse mortgage that, well, but I don't want to touch the home because that home is going to my kids, and I want to leave this to my heirs. And that came up on my call that I was referencing today. And she said, well, I'm hesitant to touch the house because my plan, my whole life, was to pay off my house and leave that house to my kids. And my response is always, I understand. I want to respect that you want to leave a legacy to your kids. There's other ways to leave a legacy to your kids. And if you use a reverse mortgage, it's likely that if you couple that with doing the right things here, here, and here, you're actually going to wind up leaving more money to your kids because the home is a low growth potential asset. Your other investment portfolio, particularly over the past decade, past 12 years, I guarantee you your investment portfolio has been accumulating more interest than the level of
Equity.
growing in your house.
Absolutely.
And so it makes sense to use the home equity first and to couple that equity with limiting portfolio withdrawals to allowing your portfolio to continue to grow and compound interest. Then you have a larger pool of funds to pull from. Then it's what can you do with these funds? Can you fund a long-term care insurance policy? Can you make upgrades to the home? A reverse mortgage for purchase, probably not enough show to get into that. An incredible way to buy your next home using a reverse mortgage, buying a home that's more suitable for your long-term care needs. Maybe instead of retrofitting the home, instead of doing renovations, you buy a house that's already renovated, that's already suited to meet your long-term care needs. You can buy that house with a reverse mortgage loan and preserve a whole lot of extra cash flow that can then be allocated towards other things, insurance, just savings, emergency funds, savings for a rainy day, all of these different concepts. But it takes somebody actually going through this educational process and discovering what's available to them and not being afraid that they're going to be sold a product or a service. Speaking to individuals that care, that are passionate, that aren't in this for the transaction, that are in this for the long haul, that want to make sure that they're doing the best thing for the client, first and foremost. And then, of course, if it's the right fit, of course, we want to do a reverse mortgage for you. Of course, Bill would love to sell you an insurance policy. But I think his reputation is more important than your transaction. My reputation is a lot more important than one transaction. And so reach out. If that's the takeaway from this show, if folks reach out and just become educated, then I think we've done our job.
Yeah, there's no doubt. You had mentioned, Bill, we have less than 4 minutes. Go ahead, Bill.
No, I wanted to say, Stephen, that's a great story. And I want people to remember, and this is just part of expanding your mind, and you look at things and don't let everything come down to a zero-sum decision. It's not just financial legacy that we leave our kids and grandkids. It's lifestyle, it's experience, it's engagement, it's relationship. I have met people who have worked so hard to leave their heirs X amount of money or Y piece of property, yet along the way they needed care and the relationships fell apart because everybody was fighting over what kind of care was best for mom, or we can't afford it at home and she wants to stay at home, and so on. And Stephen, you heard me say this in class. One of the things that we say all the time, and it's a phrase from our founder, Harley Gordon, an elder law attorney, that buying long-term care insurance or having enough funds to pay for your care is a second gift of life to your kids.
Yes.
So that they don't have to, or so that they know there's professionals that help. And I think that that's maybe a more important legacy.
Yes.
I'm preaching a little bit here. Everyone gets to decide what's most important. But the legacy is both money, property, as well as these more subjective things also. So,
well, we only have 2 minutes left. And, Stephen, I haven't done a show, we haven't done a show strictly on reverse mortgages in probably 5 months. I'm always cognizant of the fact as we build a, audience, I don't want people going, well, that's what Mike Banna does for a living. He's pushing reverse mortgages. We're not. But I think it's time. I think it's time for you to come back on the show and spend a certain amount of time talking about what truly happens when the first borrower dies, how the surviving spouse is protected, what happens when the last borrower dies. This is not the reverse mortgage of yesteryear, how the children and the heirs are protected, the options they have, the time that they have to make up their mind. And we got to spend at least half the show on the purchase reverse mortgage. Because can you imagine certified financial planners, instead of saying to mom and dad, to one of their clients, you just made $500,000 on a house in New Jersey, you're moving to Florida, buy a house for $500,000 so you don't have to touch your portfolio. Instead, buy a house for $500,000 if you're both 65 years old. In today's interest rate environment, you only put up $250. Stephen Sless will give you the other $250. You'll have no payments, and then give me back the $250. I'm your financial planner, and I'll turn that into $500,000 before you're 80 and run out of money. We got to do
I'll
shows
watch
on
that
this.
show,
We just got to do it.
and I'd like some CE credits if I watch it too.
You got it. With 30 seconds left, I've never said this on a show because I don't push, but we talked about this a little today. If you have any questions, please contact Bill, contact Steve. If you're an insurance professional or a financial professional and you go, wait a minute, I know the company I work with won't do this, contact Bill, contact Steve. We'll arrange for a reverse mortgage show, Steve, you and I. 10 seconds left. Thank you guys so much for being on the show, for being part of the initiative. Stay healthy, stay safe, keep your masks on, and we'll see everybody in 7 days at the next 62 Who Knew. Thank you.